Welcome back to The Explainer. I'm absolutely thrilled you're here today because, well, we're jumping straight into Lesson 8 of our testing series. Today, we're putting a heavily debated trading strategy right under the microscope, the golden swings. Look, if you've been searching for a purely mechanical, no-nonsense, rules-based way to defend your capital out there in the markets, you're in the exact right place. We're going to rigorously test these concepts to see if they're actually unbreakable lines of defense or just another retail trap. Let's get into it.
All right, let's dive into this. Picture this. You're looking at a fantastic setup. The chart is pristine, you place your trade, and then, bam, you get swept by this microscopic wick. It's like the market's favorite practical joke, right? You're knocked completely out of the trade. And then, as if the market's just openly mocking you, the price immediately explodes exactly in the direction you predicted. It is an agonizing feeling. We have absolutely all been there, and honestly, that's the exact pain point this golden swing strategy is trying to solve.
You know, the core issue we're tackling here is that massive gap between emotional trading, all that guesswork based on how you happen to feel that day, and mechanical trading. We're stepping completely away from that tangled mess of hoping and guessing and moving toward a highly structured, armor-plated set of rules. The goal? We're letting specific candlestick formations prove to us exactly where the smart money is stepping in to defend the price.
So here's our strict test protocol for today. First, we'll look at the three-candle foundation. Second, the intermediate fortress. Third, trailing stops mechanically. Fourth, the fractal nature. And finally, number 5, the final verdict.
All right, step 1, the three-candle foundation. We're starting at the absolute micro level here because, well, these are your essential building blocks. The most basic unit we're testing is called the short-term low, or STL for short. By definition, an STL is a bullish three-candle swing formation. Now you need 3 distinct candles for this. The rule is incredibly simple but very strict. That middle candle must have a higher candle on its left and another higher candle on its right. According to the source material, if the overall price is moving toward higher time frame objectives, these specific short-term little swings shouldn't be broken until that larger target is fully hit.
What's really brilliant about this is just how simple it is to spot. Basically, you're looking for a giant V shape anchored right there in the middle of the action. That V is your three-candle swing. The absolute bottom point of the V, that's your middle candle, completely protected by those higher candles on either side. Whenever you see this V lock in, the rules dictate that a newly defended level has just been established.
Moving on to step 2, the intermediate fortress.
Okay, this is where we level up. We're taking that base unit and upgrading it into a heavily defended structural point. To build what the strategy calls an intermediate term low, or ITL, you don't just need 3 candles anymore, you need 3 full swings. So first, you find a middle 3-candle swing, that V shape we just covered. Second, you confirm there's another entire 3-candle swing sitting to its left. And third, you confirm there's yet another 3-candle swing to its right. The absolute golden rule here, that middle swing has to be the lowest point of all 3. Once you have that, boom, you've officially identified an intermediate term low.
I actually really love how the source material describes this. It says, an ITL is like a fortress. It should remain completely safe and unbreakable. Our whole test today hinges on this exact theory. The premise is that as long as your higher time frame bias, so think your daily or 4-hour chart, as long as that bias is undeniably bullish, this intermediate term low fortress is incredibly secure. The market shouldn't even come close to breaching those walls.
Which brings us to step 3, trailing stops mechanically.
So how do we actually put this fortress to work? Well, we take these stationary definitions and put them into motion to actively defend your capital. In a confirmed uptrend, every single time a new short-term low forms, every time that new V shape locks in, it represents a newly defended level by smart money. Because of this, you can safely trail your stop loss right behind these new STLs. And honestly, the crucial takeaway here is that this completely removes human emotion from the equation. You aren't guessing, you aren't panic adjusting your stop because you're nervous, you just wait for the 3-candle formation to lock in and then you move your stop. The rule states these STLs shouldn't break until your ultimate target, the intermediate term high, is finally taken out.
Now for step 4, the fractal nature. This is where things get super interesting, because the strategy expands from just a simple tactic into a comprehensive view of the market. The market is fractal, right? Meaning patterns repeat themselves at every single scale. So let's compare what the source calls the boss timeframe to a lower timeframe. If you spot a simple short-term low on a 1-hour or 4-hour chart and you zoom into that exact same spot on a 15-minute chart, you'll almost always find a massive, heavily fortified intermediate term low right there. The lower timeframes deeply respect the swings created by those boss timeframes as major, undeniable turning points.
And the real-world results of combining these fractal pieces? They're pretty astonishing. Get this, according to the source's testing, by using this exact mechanical method, traders have captured massive, I'm talking 500 to 600 point moves in instruments like Bank Nifty. And because they're trailing their stops mechanically behind these fractal fortresses, they're doing the whole thing while maintaining a tiny, highly protected stop loss. I mean, the risk-to-reward ratio here is just incredibly compelling.
And finally, step 5, the final verdict.
All right, moment of truth. We've arrived at the climax of our lab test. But before we go ahead and declare this system flawless, we have to talk about the critical caveat, the one thing that can make or break the entire approach. Here is the ultimate truth of the market. It all comes down to higher time frame bias. If your overall reading of the market direction is just flat out wrong, it literally doesn't matter how perfectly formed your three-candle swings are. It doesn't matter how meticulously you built that intermediate term low. If the larger market trend is heavily bearish and you're trying to buy off a bullish fortress, well, that fortress is eventually going to fall. The mechanics only work if they're operating in total harmony with the dominant market current.
So the lab test results are officially in. The golden swings absolutely pass the test, for sure, but strictly on the condition that they are aligned with that higher time frame bias. When you nail that part, these structures act as the ultimate mechanical line of defense for your capital. It just brilliantly illustrates how combining strict rules with larger market context creates a massive edge. By the way, if you're ready to start marking these swings on your own charts, the source material actually provides a full ITH and ITL structure PDF. You can grab that resource for download directly in their app to help you follow the rules step by step.
We've seen exactly how to defend our capital once we're already in a trade. But like we just said, the whole shebang completely hinges on getting that higher time frame bias right. Which begs a really massive question. Is it actually possible to accurately predict price direction before the market even opens? Well, that is exactly what we're going to test in Lesson 9 when we break down the daily bias formula. Believe me, you won't want to miss that one. Until next time, keep learning, stay focused, and happy analyzing.